So as you know, in Europe, the risk weights are calculated according to different options, but the most used option is internal models. Internal models were proposed by the Basel Committee in 2005 in the Basel II Accord. Basel II, probably for those who have been working in regulatory matters and policy standards, is fantastic. Basel II is a piece of, not regulation, but global standards that make a lot of sense. They have Pillar 1 with risk sensitiveness, with credit risk mitigation techniques, that was an improvement to adapt to the reality of the banking business, with Pillar 2 to let the supervisors review everything and impose capital add-ons where need be, and also Pillar 3 to enhance communication and transparency. It was absolutely well conceived. As any complex machinery, it needs some review from time to time. But Basel II is absolutely sound. Basel III is exactly the same as Basel II. It only requires more capital. That is the only change. And then liquidity. That was the main addition in Basel III, right? But what we are doing now is to change the whole Basel II. What is the bedrock of the regulation and the standards that are applied to calculate the capital ratios of banks? That is why the revision and the way is so important. So I wanted to stop here with some reflections about the risk weight density. The thing is that, let me underline here in front of everyone, the American banking sector is very sound. I would invest in the American banking sector, no problem about that, no objection. We are going to talk simply about certain technical differences that need to be known for a correct interpretation of the risk weight density. Okay. This risk weight density, there was a study of the International Monetary Fund in 2011 that shed light on the question of risk weight density. It was a main contribution for everyone, all the stakeholders in the banking industry, to know more about how the risks were being calculated in the global standards. Well, the upshot of this was that apparently the risk weight density on average of the EU banking sector was those days 35%. And the American banks showed 57%. Obviously that is a gap. It needs to be explained. It needs to be explained. After that, if you have followed the communications and the news and the media, many times it has come to the front page of some papers that the European banks have a kind of privilege in terms of risk weights. It has been always put in a way that shadows a little bit the image of European banks because of this gap. And it is true. That gap is, you run the numbers, you take the reports, and it is completely true. The risk weight in Europe is about 30-something, and in the US it is 50-something. Yes. So, but we need to look what is behind that. First, accounting standards, as we mentioned. In the US and in some other countries, they apply local standards. And those local standards allow netting. Okay, that's a way to present the accounting information, no problem about it. In Europe, we apply IFRS, and the derivatives are shown in the gross amounts, and that makes a huge difference. So there is nothing wrong about it, but the famous risk weight density is your risk-weighted assets that go to the capital ratio over your total assets. Right? So Europe has 35 risk-weighted assets over 100 assets. So the risk-weighted density is 35. And the US has 56 over 100, 56. Okay. But the thing is that the total assets in the denominator in the US are netted. So for the same assets, the same bank, under IFRS, the risk weight density, this metric of the risk weight density looks lower in Europe under IFRS than under US GAAP. Simply that. There's nothing wrong about that. Simply that. The risk-weight density is affected by the accounting standards. And this effect is important. We don't have updated data because it's quite difficult. There was a study back in 2012, I think, by Ernst & Young. It showed the magnitude of that, and it was quite important. We are not able to be very precise, but it could be between 4 or 6 points of risk-weight density. So that risk-weight density of 35% should be lifted to maybe 39, 40, 41, something like that, if we put the European banks under US GAAP rules, or the other way around. So that is one big difference. But there is another one that is even bigger. It is the structure of the market. And again, here, no objection. We have different traditions. We are implementing global standards in the last 40 years, but the history of banking is much longer than that. The thing is that in the US, they have a system by which the residential mortgages, and all kinds of mortgages in fact, are sold by the banks and then transferred to government-sponsored entities. Okay, that's a model. Nothing to think about that. In Europe, we keep all of our mortgages in the balance sheet of banks until maturity. Even if they are securitized, they are kept in the balance sheet of banks, and they count when it comes to calculate the capital ratios. So that also gives a difference in the way you calculate. Because obviously, especially residential mortgages is probably the lowest risk profile portfolio, always, in every country. So the thing is that if we take mortgages out, mortgages represent 1/4 of the balance sheet in Europe, but also in Japan and also in the US, more or less 1/4 of the assets and the loans in the banking system are residential mortgages. If we take them out, obviously, the risk weight is pushed up. That's what happens in the US. You take out the lowest risk profile asset in a very important magnitude, and the result is that the risk weight density at the end is higher, or the other way around. If we did the exercise to take out the residential mortgages from the balance sheet of European banks, put them elsewhere, that would pull down the risk weight of the whole sector, the country. So that would mean an addition of about 5 or 6 points in the risk weight density of Europe if we took out the mortgages. So that is another piece of information that needs to be understood to interpret that gap. And again, there is no policy here. I mean, these are traditions in the banking sector, nothing to object about that, but it needs to be known. More importantly, Pillar 2, and this is probably the most important chunk of difference to explain that gap. In Europe, the decision to implement Basel II was taken very early, and as part of Basel II, we implemented Pillar 2. And in all countries, there has been a capital add-on, substantial capital add-on. In the US, it took longer to implement Basel II, so they didn't have any Pillar 2 because Basel II was not implemented, at least when this report was published, showing that difference in risk weights. What happens here is that today, the Pillar 2 capital add-on in Europe is roughly 4%, ranging from 2% to 8%. I think no bank is much lower than 2%, or 1.5 should be maybe the minimum. If we have a look at the European Central Bank, more or less is 4% over risk-weighted assets. That's a lot. It represents more than 1/3 of the regulatory pressure. And of course, that is not computed in the risk-weight density, because the risk-weight density is only Pillar 1. And that is a very important point in the current discussion, because the Basel Committee is absolutely right that the risk-weight density of some banks is very low. Okay, it's very low, yes. But Have you looked at the Pillar 2? I can't give examples, but there are certain countries, some small countries, that have the lowest risk weights in residential mortgages, but they have the highest Pillar 2. So what do you prefer? 7% of Pillar 2 and a very low risk weight, or double risk weight and no Pillar 2, or reduced Pillar 2? It's not clear. Pillar 2 is very important in terms of regulatory pressure for banks and needs to be taken into account in any overall assessment. Without that, any conclusion is skewed. And that is what is happening with the risk density. This is important for the discussion. And finally, I also highlight 2 points that are minor. I mean, it's not that much. Operational risk, those days, it wasn't computed. It's the same thing as Pillar 2, but the effect is much lower. And also this question of software that we have been claiming the Commission in Europe, that the software is an investment. Okay, it is intangible. You can't touch software, but it has been deducted from capital, and that is not a very good decision. In the US, at least those days, they risk-weighted it 100%. Well, we think it's a much more reasonable treatment, especially because the evidence says that software has value even when a bank is liquidated. You have several examples. One of them was BNP Paribas, took over La Banque Fortis, and in the statement of the purchase, it is indicated the amount that was assigned to the software of the bank, and it was more or less the book value of the software. And in some other cases of mergers and takeovers, it has also been proved. So the question there is whether if we liquidate, if this is a bank and I have to liquidate this table, this part of the equipment, it is 100% risk weighted, but my software would be deducted from capital, when it's 12 times more expensive in terms of capital. And we don't think that this table has a value higher than my software in case of liquidation at all. So there's something there that needs to be changed. It's not a substantial difference in terms of substances, peanuts compared to Pillar 2, of course, but it's very strategic because we are moving towards a world of fintech and digital banking. And banks are investing more and more in software, our software. The main issues here to explain the gap, again, is accounting standards, the structure of the market, especially residential mortgages, and mainly Pillar 2. We need to take those elements to factor them in the comparison in terms of risk density. So we think, according to our estimates, this is rough, but gives an indication. Probably the risk weight density, that those days sat at 25%, would be probably around 55%. If we consider these 3 factors. So the conclusion here is that if we take overall all the elements of prudential standards and regulation, their weight of regulation in the US and Europe is roughly the same. It's very similar, with different components, but very similar. So what should be done? This part is refers to the revisions underway by the Basel Committee. And the views of the European Banking Federation, the common views of banks. Across countries there are different views. So in France there must be a position, France must know very well. Okay. But we have a summary of views across Europe that I will show here. First, it is important for all European banks to maintain the advanced internal rating-based models for corporate exposures in the first place. It has been said that in corporate exposures, and this is totally right, the Basel Committee ran an exercise of variability in the assessment of the risk weights in large corporates, very large corporates that are supposed to be allowed for portfolio. The conclusion of that report was that there was a wide range of risk weights. Totally true. We need to do something about that. You take a company, Unilever, and then a bank rated Unilever in a way that gave a risk weight of, say, 95%, and another bank gave 70%, another bank 40%. So there needs to do something about it. And the Basel Committee has taken those observations to take decisions about the way models are being used. What we think is that they are probably going too far, because if you want to fix the variability in certain models, you need a final analysis. That is what the European Banking Authority is doing. When the Basel Committee started with that revision, it was 4 years ago. Then the European Banking Authority had not started to look at models in Europe. The banking union wasn't there. There was no single supervisor. The world has changed. And that is a message that the Basel Committee is taking. Yesterday, when the Secretary General was in Brussels, he was very adamant that the impact wouldn't be as high as the industry thinks. Okay, they have the best numbers, and they can run their own simulations. Okay. But a point that was acknowledged and positively taken, I think, and it is an avenue for us to explore there, is that given that we already have a very serious European Banking Authority looking at models with that program of benchmarking that is currently underway, and a single supervisor that has united 19 former supervisors in Europe, the reality has changed dramatically. 5 years ago, we had 24 different jurisdictions, 24 different supervisors looking at models and authorizing models. Now we have, across the world, only 4 or 5 big ones. We have no American, but they don't have models. We have Japanese, Canadian, the PRA, the UK, the SSM, the Danish and the Swedish. That's all. So there is an opportunity now to really run a very consistent analysis of how models are being used. And the SSM and the EBA are determined to take action and to change what needs to be changed. And it could end up in an increase in capital for a bank, but at least it will be grounded on a technical analysis. That is why we don't think the solution proposed by the Basel Committee is fair, because they are taking the output floor as a solution to indiscriminately set a floor for everyone with no further analysis. We think that the issue is too serious to do that, and it would require a more well-informed analysis before we start touching risk weights in different banks. They talk very much about outliers. Okay, you run statistics, and in any statistic, in normal distribution, there are always outliers. But there are many reasons mixed that can explain the risk weight of an institution. Some of them can be legitimate, some others perhaps not. It depends on the technical way in which models have been calculated. That requires a thorough analysis. Stands for unilaterally cancelable commitment. So these commitments now have no credit conversion factor. These are mainly credit limits, and banks operate, especially with corporates, but also with retail customers, with credit limits. So they give to a company for all the finance of that company, be it export credit or working capital or whatever it is, they give 20 million euro limit, so that the financial officer of the company, of the corporate, knows that he can make use up to 20 million, because the use of credit by a corporate, it has some seasonality, has some peaks and troughs. So they can manage in that way the financing needs they have. And the bank sets a limit that is comfortable to the risk appetite of the bank. That is the way we operate. Until now, typically a corporate makes use only of the part of the credit limit that it needs, because it's more expensive, and leaves a certain room, cushion for financing that is not used. That part has no effect in capital requirements in banks as according to the current rules, if that limit is unconditionally and unilaterally cancelable by the bank. So obviously the bank at any point can say no more credit, and the only risk for the bank is the outstanding amount at that point in time. Right. So the Basel Committee, we need to understand, they fear that at some point a bank would lose more than the outstanding credit to the bank, to the corporate, sorry. And they have a point, could be, but we need more analysis on that. We need more evidence, and we know they are working on that. Because there was just a proposal for a 2% or 20% in some cases. It is a Congress proposal is there in the Basel consultative papers to place on credit conversion factor to the unused part of a credit limit, even if it is unconditionally cancelable. Right. So that would have an effect also in the way that banks offer credit to corporates in the long run, because if it has a capital cost, and capital is very scarce these days, but the bank would think instead of 20, sorry, but I have new rules and I might offer only 12. So if we analyze the use of credit of a corporate throughout the year, maybe during the most of the time this company has 8 million outstanding amount of credit. But at some point during 15 days it has 20 million and makes use of the total credit. So they really need that upper limit. If it is at a cost, at a capital cost for banks, it would be discouraged. Right? So that is the problem behind this. But we also understand, the Basel Committee is good. I mean, they are critical and they think, okay, there could be a risk there, but then run statistics, run observations, and see if there was risk in that induced limit. So that's the second point. Third point is to recalibrate the mortgage risk weights in the standardized approach. There we think that yes, residential mortgages are very important for Europe, not for other jurisdictions, and we need to recalibrate that. And in particular, the loan-to-value below 50% should be made more granular. Basel Committee came with a proposal for the standardized approach that added some risk sensitivity, but it should be made more sensitive in the best quality tranches of the portfolio. It could eventually give some recognition to other features, even if it is a global standard. In some jurisdictions, a different ratio, complementary ratio, could make sense. Sorry. Because mortgages are very important in all countries in Europe. So loan-to-value is a very strong indicator of the riskiness of the portfolio, but it could eventually be complemented upon the discretion of local supervisors. Could be. There are different features in all countries. Some countries argue that the loan-to-income could also be taken, but it has complications. Loan-to-income is a very difficult ratio to keep and to define and so on. Yeah? And we understand there that the Basel Committee seeks to avoid complexity. The loan-to-value is very simple, so simple. Yes, the value of the loan compared to the value of the property is very simple. The loan-to-income needs to be defined. If they are typically two borrowers in a mortgage, then you need to track there, because if there is a divorce, then there is only one borrower and you don't know. So it will be a complication for the banks to be very precise in what is the loan-to-income ratio throughout the life of a mortgage that is very long. But it also has risk information. That is a balance between complexity, cost, and the amount of information that it adds to explain the riskiness of the portfolio. But this is being discussed. It's still being discussed in the next 2 months. The leverage ratio has been accepted, and we think that the output floors, first, they limit and discriminate the risk weight of all banks. And I think this is a very serious issue that deserves a more technical analysis by bank and portfolio by portfolio. And on the other hand, now that we have a leverage ratio serving the function of backstop that was agreed in Basel III, there's no point in introducing an output floor that is another backstop measure. It is a complication, and it is even more, more complicated to understand the result of the capital requirements if we put an output floor. It will make the life of analysts more complicated as well, and there are many interlinkages there. So when this output floor is, just to explain, is for banks that have internal models, they should calculate in parallel the result and the standardized approach, calculate at 70, 80 or whatever is the level of the output floor to the standardized approach, and that would be the floor of the true result of the IRB models. That is the floor amount. So it also implies a double calculation for banks and for ever, which is not warranted. Then the operational risk question. The rules for operational risk have been changed. Fair, okay, the Basel Committee has taken a decision to change the rules. But the underlying risk is exactly the same. So whatever they come up with, it should end in the same amount of capital requirement. And what we have seen is that it will mean a big increase in the operational risk capital requirement. They are working on that as well, apparently. And finally, what I have mentioned before, now that we have, in Europe, we have now the European Banking Authority and the SSM looking at models, they should rely more on supervision. This was just a little of corporate because I think if there is one element in the proposal that needs to be carefully reviewed is corporate, because of the implications it has also in the capacity of banks to finance corporates that are sustaining the future economic growth, and that's the main objective now in Europe. Corporate, well, this was a detail in the presentation, that corporate, depending on whether it is a company or a larger group, will be risk weighted differently. So that needs to be changed, and we know that the Basel Committee is looking at that as well. And just finally, as a summary, the options that are being considered are around these issues. Obviously, there are technical working groups working on this, and we do not have any information, but they will be discussing about this. What to do with bank exposures? Should they be kept in internal models or shifted to a standardized approach? That is one question. I think it's more likely that they will move to a standardized approach, but let's see what happens. Corporate, we have talked about it. Retail exposures is mainly the question of mortgages. Equity exposures, also importantly, equity doesn't represent a lot in terms of assets of the banking industry, but it's also important, and it is subject to an increase to the capital requirements that needs to be reviewed as well. Specialist lending is another important portfolio for European banks, more than ever before, because we have a program in the Commission to invest in infrastructure in the next years. And there is a review of specialist lending that increases the risk weight, despite the fact that the observed credit losses of specialist lending, credit finance, aircraft, shipping, and so on, the credit losses are lower than the current treatment. And that current treatment is going to be increased according to the proposals. We know that the Basel Committee is looking at this very, very carefully, and they will probably come back to a more reasonable level. the residential mortgage portfolio is key for the European banking sector. Off-balance sheet items is a question of the credit conversion factors, needs to be reviewed. The output floors. We don't want output floors, that is our position. If you ask me, I think they will need to put an output floor because the pressure is very high. We are hopeful it won't be like that. The pressure is very high to put an output floor. The Canadian and the Japanese and the European are against the output floor. If there is an output floor, we need to define first the level and then how it is calculated, and that also matters. Obviously, if we move above 70%, it starts hitting dramatically the risk weight of the whole European sector. It affects banks to varying degrees across countries. That depends on where the risk weight of the bank is now, obviously. But that will be the most controversial issue to discuss in the next 2 months. And there are many other issues because the conclusion there is that the new proposals are really complex and difficult to understand. So they need to do something about it. Because even the impact assessment and the quantitative impact study they have conducted is very difficult to see because of the many interventions. That is the conclusion. I will have talked about Basel IV for 1 hour now. We could be there for days or weeks. We will be talking about this in the next weeks and months. And I will be happy to take any question if there's still time for that.